Okay, and I don't see anyone else on here yet. So, but this is recorded, so we'll go ahead.
Okay.
All right. Good morning, everyone. I'm Care Kaufman with Care Home Team Real Estate, and I'm the owner and broker of it. We're located in Bellevue, Nebraska, home of Offutt Air Force Base. This morning, I'm here with Greg Acero with Fairway Mortgage, and we are talking about the real estate market on Everything Real Estate today. So welcome, Greg.
Hi, Care. How are you?
I am good. How are you doing?
I'm doing fantastic. Thank you very much.
Good. Well, I'd love for you to introduce yourself and tell us a little bit about you before we start talking about the market.
Yeah, absolutely. Thank you. Well, thank you again for the opportunity. I really appreciate you allowing me to join your group here and to go live and answer questions for everybody. Again, my name is Greg Acero. I'm with Fairway Independent Mortgage Company. I do residential lending, been doing that 20 years here in the Omaha marketplace. Been with Fairway now about 5 years, and really just focus on, at the end of the day, really providing a different client experience, a better lending experience for clients through purchasing homes and building wealth in real estate. That is my main objective. So really just educating and teaching people how to take real estate and use that as an opportunity to build financial freedom for yourself.
Very good. So can you tell us what you're seeing today in the market?
In today's market right now, for the last 18 months, roughly, we've seen interest rates continue to climb up, creating, some, affordability kind of, hurdles, if you will, over the last, year and a half. And it's really been a stress test for the real estate market. So really these interest rates, as they've kind of gotten to a high point, we've seen the market slow down, and a lot of people really kind of question if now is a good time to buy or not. And so what I've been really focusing on is educating on if you need to buy or want to buy, what does that look like, and how do we take advantage of what the market has to offer, and where's the market going? One question I get often is, Greg, what do you see interest rates doing in the next 6 months, 12 months, 2 years? And I wish I had a crystal ball that gave me that answer, because I maybe I'd be doing something else for a living. But I tell everybody, my honest answer is I believe that in the next 1 to 2 years, interest rates will improve, creating an opportunity to take advantage of that. But in the interim, where rates are at now, I believe that if you're a buyer and you've contemplated buying, especially if you're a first-time home buyer or you're renting, what would you do in the current environment to take advantage of it if you could? Because rates seem really high. And I focus on educating of the power of real estate and leveraging what I call good debt, and taking the opportunity of the market's not so strong of a seller's market right now. We've seen the ability to negotiate deals. It's really just comes down to supply and demand. Yeah. And we've seen supply be really low for quite some time now. And demand, when it was high, because rates were low, created a really tough market for a buyer.
Yes, it did.
Yeah, and I just feel like over the last 6 to 12 months alone, rates kind of really hit a high point and stayed there, and buyer demand went down. So if you were a buyer, all of a sudden you kind of were dealing with a different market in your favor as a buyer. And so I think people are taking advantage of that if they're needing to buy. But those who want to buy, it's the question that becomes for them is, why don't I just wait till rates go down? And so just been focused on educating on that, because I think there's value in real estate, particularly in the Midwest and in Omaha, Nebraska. And if we're really thinking about buying, if you wait till rates come down, the biggest problem I see is so will every other buyer that's been waiting. And now you're back to dealing with high demand, low supply, which that's price appreciation, that's fighting over properties, multiple offers. It can be very frustrating. And for what you thought you saved in rate, you spent in price.
And sometimes more.
With
what we saw during the pandemic.
Yes.
Yeah.
And so just educating around that. At the end of the day, I'll never make a decision for somebody. I'll just give them my opinion, my advice that I can share. But I just try to use the data in front of us to really educate and let that speak for itself on if buying makes sense or not.
Very good. So if a buyer's been looking and they're thinking they want to wait because interest rates might go up, how does that 1% of a change in interest rate affect their buying power?
Yeah, good question. I mean, that 1% makes a substantial difference in their payment, just as well as $1,000 in price. And let me say something first before I answer specifically on the 1%. But right now, for every $1,000 is about $7.50 on your payment. So what I mean by that is if the prices go up in the spring or summer when you're looking to buy, for every 1,000 is $7.50 potentially. That can add up really quickly. And the opposite of that is, well, if you could buy today and save yourself thousands of dollars, you could save $7.50 for every 1,000. And if you can negotiate right now a better deal, a lot of buyers emphasize price cut or price reduction. Mm-hmm. Where you'd be more strategic to use the money from the seller to get a better interest rate, because that does more work for you than just reducing the price.
And so you say money from the seller.
Yes.
So you're advocating that we would ask the sellers to pay money like we used to do towards closing costs, but now have them go more towards a rate buy down?
Absolutely. I would educate first and then show them, illustrate an example of how, if you can negotiate a deal, and I think it's case by case because it depends on the house and the sellers, the days on market, many things. But if you could get concessions from the seller, don't reduce the price, take the same amount of money and use it to get a lower interest rate to get more savings out of that, or better payment or cash flow than just because of reducing the price. Because it just doesn't work. For example, if you reduce a price $10,000, you're saving $75 a month on your payment approximately. Well, I have my little handy calculator here. If I use a $300,000 loan example, which is very typical here in Omaha, if I take $300,000 at 7.5%, your monthly payment for principal and interest is $2,097. If I reduce the price to $290,000, 10 grand, I then lowered my payment to $2,027, about $70. Where if I left the loan at $300,000 and reduced the rate, say 1%, 7.5 to 6.5, instead of $2,097 at 1% less than rate, I go to $1,896.
Wow.
So it's a substantial improvement in payment and interest paid back by using that same amount of money towards your financing or rate, if you will, than reducing the price of the house. And so I really focused on illustrating and educating clients on how to make the money best work for you.
That's very interesting. I've seen that people post about that, but I wasn't sure exactly how that works. So that's great.
Yeah. So to answer your question on that, Care, what's 1% do for you? Well, comparatively, we were at 2,097, 1% less, we go to 1,896, essentially $200 a month in payment savings for 1% on $300,000.
Mm-hmm. Well, and one thing that I'd always been told was that if rates go up 1%, you lose 10% of your buying power.
I mean, it depends on income. We have to factor income in there for a minute, but yes, you're losing buying power regardless.
Right.
Because we just illustrated the example of a $200 change in payment month to month. And that's just on one monthly payment. Everybody to some degree has, most likely, I assume, some other sort of monthly payments, for housing alone, utilities, those type of things, housing costs. And that's not even factoring in other outgoing liabilities you may have from student loans, auto, credit card. So it does play a role into somebody's monthly budget. And yes, interest rates have gone to where it's really been a stress test for affordability. But I think this market right now is offering an opportunity for buyers to negotiate because the market's pivoted and it's not so much a strong seller's market. And you can negotiate. And if you have the ability to do that, you can work this more in your favor. And if rates go down in the future, 12 months, 2 years, 3 years, whatever, you could then later refinance for better savings on top of that. But at least you already have the house. You didn't wait and pay more for the house.
Right. Yeah, because that's a definite from what we're seeing is that the prices are going to keep appreciating.
Yes, especially in Omaha, Nebraska. Our population forecast for growth is 2.3% annually. That's a large growth, and we are like I just read this, but we're like the 9th fastest growing city per capita in the United States. So we have a lot of people transitioning to Omaha for work. There's a lot of technology growth here. There's a lot of already a lot of money. It's a very rich city.
Yeah.
And there's a lot of not only business growth, but growth in just overall population and families. The need for real estate will be here for, I think, the long term, which creates, again, demand, but the supply can't catch up.
Yeah. And that's going to be a very difficult thing for the supply to even come close.
Yeah, new construction can't keep up, and I don't see how they're going to fix that anytime soon.
No. Well, new construction seems to be getting more expensive too.
Yes, it's interesting. I've been looking at replacement costs on when I'm valuing a building or a house, and it's one ways of looking at when you're buying a property. If you're looking at buying an investment, what's replacement costs compared to what I'm paying for it? Because what I have found is replacement costs have gone up substantially, but you can't build it for replacement cost.
Right.
Because of the cost of labor and material.
Yeah. Yep, that's gone up quite a bit.
Yes.
So what is your best piece of advice for buyers that are wanting to move forward but are hesitant?
I like to believe in, I think it's all math at the end of the day, and I want the numbers to tell me how to make a decision. I think it always starts with getting all the information I need to make a decision first. So get all the information. Do your due diligence, research it, understand the market, work with professionals that understand what they're doing and how this all works. And then once you gather all the information, it'll tell you what the decision is. And I believe right now, everything's telling us we should be buying as much real estate as we can because of the future appreciation around the corner alone, but also the population growth, the business growth, the amount of families I see moving here from other states, that growth. I just think there's so many factors that are showing how we have a lot of upside here. And real estate is one big thing to take advantage of. And I'm a firm believer in, again, you build wealth in real estate.
Right.
And I just think if you wait to buy real estate, I've done this myself. I go back and go, well, gosh, I should have bought that property. And if I would have done that, look at what it would be worth today.
Yep.
So just don't overthink it if you don't have enough information. Get enough information first, and then make a very decisive decision on what the facts are telling you.
Yeah. Very good. So do you have quite a few different programs for people for loans?
Yeah. So here at Fairway, we have over 1,800 mortgage products. So we have a lot. I would be lying if I said I knew every one of those, because I don't try to be a jack of all trades, if you will. I try to really specialize in what we're good at. But yes, we have plenty of products and programs to offer to the community. But we just for the standard, we have the conventional, we have FHA, VA, USDA, NIFA. If you're in Iowa, IFA, which the down payment assistant loans have been really heavily used in the last 12 months I've seen. So in fact, my branch here will probably do roughly 100 to 120 million this year in volume. And right now, about 48% of that volume will be NIFA alone.
Wow, very good.
Yeah.
So how does that program work?
NIFA is a program where essentially it offers what we call down payment assistance. So you can buy a house for, let's say, $300,000, and NIFA will then offer a standard program, conventional FHA VA, with a standard down payment that is in line with whatever that product offers. For example, FHA 3.5% down, conventional 3% down, VA's 100% financing. So from there, you then are structuring a normal loan, but you can take advantage of what's called their DPA, down payment assistance. And NIFA will let you borrow 5% of the purchase price as down payment assistance.
Wow.
So if you're buying a $300,000 house and you're putting the 3% down as required on conventional loan, that's $9,000. NIFA is going to give you 5% of the purchase price as down payment assistance, $15,000. So you have enough to cover your down payment plus another $6,000. You can use that $6,000 in that example to go towards your closing costs and tax and insurance. So with NIFA, you can come to the table with a couple $1,000s to purchase a home today for $200,000, $300,000, $400,000. So it's a great program to minimize your out of pocket and take advantage of the down payment assistance.
So there's a minimum amount, though, that the buyer would have to bring out of their own pocket?
Not necessarily. They can get the seller to pay what little bit would be remaining there as a seller credit, and they can get their bottom line to essentially, zero if they like.
Okay, I didn't realize that. Yeah. I thought there was a requirement of at least $1,000.
So NIFA used to have a requirement of $1,000, but that money, they can get it gifted to them, or we can get credits involved to where they don't have to have necessarily the $1,000 brought to the table.
Okay. So somebody was asking here, so the down payment assistance is a lower interest rate?
NIFA sets their own interest rates. So if you go to NIFA's website, just again, Google NIFA rates, and that's what I would do, and it just pop up. They post their rates daily on what they have to offer. And their rates are very competitive, typically better than what standard market rates are.
Very good. So what is your next most popular program?
Conventional is probably most popular right now because it offers as little as 3% down. And it's just it's a good loan because the rates are competitive. Most in the marketplace, we see most of the time sellers want to see conventional financing as they're I think a lot of times educated. That's probably the best financing to receive on an offer. So conventional is very popular. But again, we do FHA often. And why would somebody choose FHA? Typically, FHA is going to be chosen because they have a higher debt to income ratio, more than what conventional allows, or they have credit scores maybe in the 600s where conventional is not as attractive for rate or payment, and FHA is a better offer for financing. For example, for FHA and VA, we can go as low as a 580 credit score, where conventional is going to limit you to 620.
Okay.
So it just offers a little bit more availability in financing to the public, where conventional has a little bit of a smaller box, if you will, of the guidelines that it has.
So does the mortgage insurance play a part in also when people decide if they want FHA or conventional?
So the biggest difference with mortgage insurance between conventional and FHA is conventional is private mortgage insurance, also known as PMI. It is set up on the loan when you don't put 20% down, but it can go away once you have 20% equity. And how it works is at the time of purchase, they set it up to automatically cancel at 78% of the purchase price. However, you can remove it sooner than that based on appreciation or principal pay down. So there's no set defined time necessarily. or FHA, which is very similar in the same amount of cost per month. But FHA on a 30-year loan is for the life of the loan. And so that can add up over that long term. So I would recommend, if you have an FHA loan somewhere in the future, if rates go down, especially, refinance to a conventional loan so you can get rid of the mortgage insurance.
Very good. And that just not too long ago changed, right?
The amount of the cost of it?
No, the ability of the mortgage insurance has to stay on an FHA loan. Didn't that used to go away too?
There was I think, if I remember correctly, it's been a while, but I want to say it's probably been 4 or 5 years now, if I'm not mistaken. And don't hold me to that. I could be off on the dates there exactly. But it used to be where it cut off, I believe, after like 11 years. But they then changed the requirements to be for the life of the loan, just based on overall amount of funds available within the mortgage insurance bucket from all the FHA loans, which it's set up there for defaults, right? Mm-hmm. And so when that money shrinks down, they're looking at ways to restructure that loan to be able to help have FHA still be available to the the open market.
Sure. Okay, very good.
So one last thing, I think that since we're talking about products, I think that, for some other ones that are unique, if you will, one that we have that's of interest in our current marketplace is we have 100% physician loan. That's attractive for those looking for that are eligible. I see USDA not get used enough, but that should be a very popular product because there's a lot of properties within a USDA, a property specific area that qualify for 100% financing. So to take advantage of that. And then we are now the nation's #1 reverse mortgage lender. And I think that's a product that, when educated on, can be a great product as well for those who are eligible. And we're seeing more and more of reverse mortgages being utilized. So those are 3 I like to mention just because I see them commonly, but I don't hear them as much in the public necessarily.
Right. Well, and for a while, it seemed like reverse mortgages had a really bad rap. So is that because of lack of education, or have they changed the program?
Both reasons that you just mentioned, Kara. I think they changed the program to improve it dramatically. And 2, definitely the stereotype is because of the bad information and what the product used to be. We just need to educate the public now on what the product looks like today and how it's definitely more beneficial for someone looking to utilize that.
So is there restrictions on who can utilize it?
So I'm not a reverse expert. I have a loan officer in my branch here that is our reverse mortgage specialist. So I know a little bit, but I'm not that expert. That said, though, I do know you got to be 62 years or older to be eligible for that. That's probably the biggest item that stands out for me. And the other thing I want to say is most people do not know you can use it to purchase a home. They think you have to own a home already. You can use a reverse mortgage to purchase. So if you're 62 or older, it's something to at least maybe get educated on.
Very good. Yeah, that would be worth it. Worth getting to know more about it.
Yeah, we will be holding many events in this next coming year. We're all about educating all the real estate agents in our community all the time to just help them be more experts in their field and help their clients. And some of those events will be around reverse, so we can, again, just continue to educate on that product and many more things as well.
So in wrapping this up, what do you, I'm trying to think of how I want to say this, but what do you see as the future for 5 years? How is this connected with inflation? Is that maybe that's more the question?
Personally, and again, this is just my opinion. I believe that the overall consensus would say that rates are normal, and the market will run accordingly as needed when rates are between 4 to 6%. So if that's true, we know we need to get rates down at least in the 6s. I believe if rates get to the 6s, the market will have more movement and more demand. I believe we will get there because I believe real estate it's tougher to make it. It's very tough to be affordable right now, as well as other things just due to inflation. I think the Fed has made it real clear. They want to get the Fed, their Fed target rate is 2% for inflation. They want to get it there. There's a lot of talk now around not only pausing on rate hikes, but now future rate cuts to get it back down. So I think we're on the tipping point of where in the next 5 years, for sure, we're going to see rates improve and the real estate market really get back to moving, particularly in the Omaha marketplace. So I'm bullish on real estate for sure over the next 5 years and more, especially in western or eastern Nebraska. I will continue to be an investor in real estate for the long future and for long hold. And I want to educate more on that because I think we need to take advantage of what real estate is for the price it is here, cost per square feet. The only negative, if I had any, say about real estate is just property taxes here are generally higher than where we see elsewhere.
Yeah.
However, when you take that out of the equation for a moment, you're getting a good price on real estate here, which is why we're seeing a lot of people move here from other high-priced real estate markets. And when rates improve, that demand will pick up more, which for those who own real estate, they're going to take advantage of a large price appreciation. And that means that's a lot of equity, and that's more money you can get to work for you.
Yeah, we definitely are involved with real estate investing also. It's been a very good thing.
I believe in passive income, and I want to build a portfolio of real estate so I could have passive income and also the ability to, use depreciation and other factors in real estate to help myself when it comes to taxes and many other things. And who doesn't like passive income?
Absolutely. Yep. Well, it is time to wrap it up. Thanks so much, Greg, for being here today.
Yeah, thank you.
Comments that we've gotten are that it's been very good information.
Good.
So we really appreciate that. And it's helped a lot to have a better understanding.
Well, good. Well, I really appreciate your time and for allowing me to join you today. If there's anything I can ever do to help you or anybody else, please let me know. I'm just a call away. And again, I really appreciate the time today.
Thank you. Have a wonderful Thanksgiving.
You too. Happy Thanksgiving to you and your family.
All right. Thank you.
Thank you.
Bye.
Bye.